Hey everyone and welcome. Today we're diving headfirst into a corner of the financial world that's famous for its high-stakes drama, short selling. It's a strategy so risky that it literally comes with the potential for infinite losses. But you know what? The danger that grabs all the headlines, it might not be the one you should really be worried about. The real trap, the one that can sneak up on you, is hidden deep in the market's plumbing.
So let's just start with this pretty wild question. What if you could actually make money when a company fails? Not when its stock is soaring to the moon, but when it's crashing and burning. Well, that's the seductive promise of short selling. It's a direct bet against a company's success. And that right there is what makes this whole thing so fascinating and so incredibly controversial.
All right, so how in the world do you actually place a bet against a stock? The mechanics are actually pretty clever, and you've got to understand them before we can get to all the juicy risks involved. Okay, so put as simply as possible, short selling means you're selling something you don't actually own yet. It's kind of weird, right? You borrow shares from a big institution, think a pension fund or a big bank, and you immediately sell them at whatever the price is that day. Your entire bet, your whole game plan is hanging on one single hope, that the stock's price is going to go down. If you're right, you get to buy those shares back for cheaper, return them to the lender, and the cash left over, that's your profit.
Let me paint you a picture to make this crystal clear. Imagine there's a pair of super trendy, limited edition sneakers that everyone's going crazy for. They're worth $500. You borrow a pair from a friend, but you've got a hunch the hype is going to die down, so you immediately sell them for $500. A month later, you were totally right. The fad is over and the price has crashed to just $200. You go out, buy an identical pair for $200, give them back to your friend, and you just made a cool $300. That's short selling in a nutshell. As you can see right here, the logic is exactly the same for stocks. It sounds pretty simple when it works, right? But what happens when you're dead wrong?
And this is where we get into the danger that everybody knows about. This is the one that makes for those dramatic, splashy headlines. This is the classic textbook risk of being on the completely wrong side of a very big bet.
Just think about it for a second. When you buy a stock, the absolute most you can lose is the money you put in, right? If you buy a share for $50, the worst it can do is go to zero. Your loss is capped at $50. But when you short that exact same stock at $50, there is theoretically no limit to how high its price can climb. It could go to $100, $500, heck, it could go to $5,000. There's no ceiling. And since you have to buy those shares back eventually to return them, your potential loss is infinite. It's this lopsided risk that makes short selling so fundamentally dangerous.
Now, because of that whole infinite risk thing, your broker isn't just going to take your word for it. No way. They make you put up your own cash as collateral, and that's called margin. So if the stock price starts rising and your bet is going against you, your potential loss is getting bigger and bigger, and that's when you get that dreaded phone call, the margin call. It's your broker, and they're demanding you put more cash into your account, like right now. If you can't pony up the money, they'll just forcibly buy the shares back for you, locking in your loss whether you like it or not.
Okay, so we've covered the obvious risk, being wrong about where a stock is headed. That's short selling 101. But that's not really what we're here to talk about today. The real focus of this explainer is on a much more subtle, a more mechanical danger. And it's one that can completely wreck your position, even if you are 100% right about the company being overvalued.
So what if the company's actual value becomes totally irrelevant? What if the very system you're using to borrow the shares in the first place suddenly turns on you? This brings us to probably the single most important metric you need to know for understanding this hidden danger: utilization.
And there it is. The word of the day is utilization. It sounds all technical and fancy, but I promise the concept is super simple. Imagine a library has 100 copies of a hot new book available to be checked out. Utilization is just the percentage of those books that are already checked out. If 10 people have borrowed it, utilization is 10%. If 95 people have borrowed it, well, utilization is 95%. In the world of stocks, it's the exact same thing. It's the percentage of lendable shares that are already on loan. And as we're about to see, high utilization is a massive, flashing red light warning sign.
You can see the difference so clearly here. On the left, with low utilization, only 10% of the lendable shares are borrowed. There's a huge supply, no problem. But look over on the right. At 95% utilization, the supply is almost completely gone. This is what Wall Street calls a crowded trade. Basically, everyone is making the exact same bet, and the shelves of that stock library are almost totally bare.
Now, when utilization gets this high, it creates this really fragile, really dangerous environment. It introduces three very specific mechanical risks that have nothing to do with whether the company is good or bad. These risks are all about the simple supply and demand in the lending market itself.
The first danger is what's called recall risk. You have to remember, those shares you shorted, they aren't yours, they're borrowed. And the lender, the person who lent them to you, can ask for them back at any time for any reason at all. Maybe they decided they want to sell, or maybe their own internal rules changed. Whatever the reason, when they demand those shares back, it's called a recall.
And this is the absolute kicker. When your shares get recalled, you have to scramble to find replacement shares to borrow. Now, if utilization is low, that's usually not a big deal. But if utilization is super high, that stock library is empty. There are no more shares to borrow. And when that happens, you've got no choice. You are forced to go into the open market and buy the shares to return them, no matter how high the price is. You completely, totally lose control over when you exit your position.
And the data on this is, well, it's just stunning. For a stock with low utilization, you might face a forced recall maybe once every 8 years. It's a tiny background risk. But look at this. For high utilization stocks, the average time to a forced recall plummets to just 26 days. The danger of getting kicked out of your position goes from being a once-in-a-decade event to a constant, monthly threat hanging over your head.
Okay, let's move on to the second risk, and you'll see how this all starts to build on itself. This is where high utilization really starts to break the normal functioning of the market. See, normally, if an overvalued stock starts to rise for some crazy reason, more short sellers would jump in to bet against it. That creates selling pressure and helps bring the price back down to earth. But what happens when they can't?
High utilization basically removes the market's natural brakes. There are no more shares available for new short sellers to borrow. So if a big wave of enthusiastic buyers comes pouring in, there is nothing to stop them. There's no counterforce. The buying pressure is completely unchecked, and the price can just spiral upwards to levels that have absolutely no connection to reality. This is the classic short squeeze, and it's fueled by a lack of available shares to borrow, in other words, high utilization.
And finally, we have the third mechanical risk. It's not just about being forced to buy or getting squeezed into oblivion. It's also about the cost of the loan itself. See, the fee you pay to borrow shares isn't like a fixed-rate mortgage. Oh no, it can, and it does, change, sometimes dramatically.
When utilization is high, it's a giant signal that shares are scarce. And just like with any other scarce resource, the price to rent it goes up. The lenders know they've got a hot commodity, and they can jack up the borrowing fees whenever they want. A fee that was, say, 2% a year could suddenly become 10%, 50%, or I've even seen over 100%. All of a sudden, a trade that looked really profitable can start bleeding cash every single day, forcing you to close it not because the price moved, but because the cost of just holding the position became totally unbearable.
So now we've got these three distinct risks. You've got forced recalls, you've got price squeezes, and you've got spiking fees. The real danger here is that they don't happen in a vacuum. When a stock has high utilization, these risks can all combine to create this vicious feedback loop, a trap that is almost impossible to escape from.
Let me just walk you through this death spiral. It starts with a small, unexpected price jump. Now, because utilization is high, no new short sellers can come in to put a lid on it. So the price keeps rising. This triggers margin calls and recalls, which forces the short sellers who are already in the trade to buy shares to close out. But this forced buying looks just like real demand to the market, pushing the stock price even higher. And that, of course, triggers more margin calls and more recalls for the poor souls still left. It's a cascade of forced buying that just feeds on itself, sending the stock to absolutely absurd heights.
And this data right here reveals the ultimate trap. Just look at that bottom line. Stocks with the highest fees and the highest utilization are, on average, terrible performers. They lose almost 2% a month. Now, that should be a short seller's dream come true, but it's a total nightmare. The high utilization that's signaling the company is weak is the exact same thing that makes the trade mechanically impossible to hold on to. It's like you've correctly identified a lemon of a car, but the car is rigged to explode the second you turn the key.
So what is the crucial point here? What's the big takeaway from all of this? How does a trader or an investor even begin to navigate this kind of minefield? Well, it really comes down to understanding what the different signals are actually telling you. This really brings us to the core lesson of the day. Think of it like this. A high borrowing fee tells you that a lot of other smart investors think the stock is a bad company. That's a signal. But high utilization, that tells you the trade itself has become way too crowded and far too dangerous. That's not a signal, that's a warning.
At that point, your brilliant thesis about the company's fundamentals, it just doesn't matter anymore. You're not just betting against the business, you're fighting the powerful mechanics of the entire lending market.
So that's really the question you have to ask yourself. Are you betting against the business, or are you betting against the crowd? Because in a high utilization trade, the answer is almost always the crowd. And trust me, that's a game where the house has all the advantages. It's a crucial reminder that in the market, sometimes the rules of the game can be far more important than the players themselves. Thanks for tuning in.